The last time you went to ShopRite to get some groceries, you paid at the cash point and you got a printout showing details of what you bought and the amount paid, possibly the change or the balance that was given to you after payment. Now that slip to ShopRite is a document from which information to prepare certain books of account is derived. So it means that as a business, there are documents from which information is derived to prepare certain books of what? Of account. That will take us to accounting source documents. Accounting source documents are documents from which information is derived for books of account to be prepared. What I'm trying to say in a simple terminology or in a simple expression is that for you to prepare books of account, you need information. The documents from which you get these information is what we call accounting source documents or source documents. Information obtained from source documents can be used for verification or authentication of transaction. For instance, you want to know if a particular transaction is authentic, is real or not, you can ask for the source documents. Now, source documents vary from organization to organization. You see, the type of source documents you're likely to get in a particular organization might be different from the other organization. This is depending on the type of activities or the type of business or the type of industry that they are in. But for the purpose of this study, we are looking at accounting source documents for preparing books of accounts. The types of source document, like I said, vary from organization to organization. But for this study, we're going to be looking at some types that are similar. The first one here is what we call the invoices. Now, the invoice is raised when goods are sold or purchased on credit. Typically, when a business sells or renders service to a particular organization or to another individual, that individual raises an invoice to show that the service or the product has been sold. So the invoice is issued to customers or issued to suppliers. Are you there? For sales, and then it is received by a business for purchases. Now, the invoice issued to customers by a business is called the sales invoice. You sell to a customer on credit and the customer is here to pay. You invoice the customer. You buy from suppliers on credit and you're here to pay. You receive a purchase invoice. Now you must understand that from the perspective of purchases, when you receive the invoice from the supplier, it becomes purchase invoice. Now from the perspective of sales, when you issue the invoice to the customer, it becomes what? Sales invoice. Now there's something called LPO, which is local purchase order. You see, that is also a source document for purchases, but you cannot use an LPO because it is not final and conclusive. An LPO is an order to supply. Now, it is possible that the supply might be less than what has been quoted on the LPO. So in that case, the invoice might be carrying an amount less than what is on the LPO. So the authentic billing is what is on the what? Invoice. So you must understand that when you render a service to a customer on credit, you send an invoice. So it becomes sales invoice. When you purchase from a supplier on credit, they send you an invoice. It becomes what? Purchases what? Invoice. An invoice states goods or services rendered or purchased on credit. Now, we just discussed what an invoice is. Now, how does it look like? This is a typical example of a sales invoice or of an invoice. You can see the name of the company issuing the invoice, Fuani Nigeria Limited. You see their details, where they are. That's the location of the office. I can see Bode Thomas Suleri here. They have the website. You can see the name of the person that was sold to. You can see the product number. You can see the description of the product, the quantity, the amount, okay, of the what product. You can see the total amount here, the VAT. You can see what they call it, TIN number. TIN here is tax identification number. Okay, so what I'm saying is these are the contents of an invoice. You can be asked, what are the contents of an invoice? So you should be able to get yourself familiar to the contents of what? Of an invoice without necessarily cramming what's in there. So this is a typical example. You can get invoices on your own at home as a field work. Get used to the contents. You see, whatever you see in there is a content that is expected in an invoice. Okay? So when you're asked what are the content of an invoice, you should be able to say what is in there. You can see signature of the customer. You can see the stamp of the seller. You can see the address of the word seller. You can see the product number, the description of the product, amount of the product. You can see the address of what of the buyer and the number of the buyer as the contact number of the buyer. You can see the TIN number of the seller. You see the VAT applied. So all these are what they call the contents of what? An invoice. Get used to them. The next type of source document is the receipt. The receipt is an evidence that payment has been received. So for instance, if you pay for an item, you are issued a receipt. That's an evidence that what? The payment has been made. A typical example is the same receipt you get at ShopRite. You see, once you pay, they print out something and give to you. That gives you, a detail of what you have purchased and then how much you paid. So an evidence that says, that payment for a service or a product has been made is what we call the receipt. You see, so if there's a part payment, it will show you. The balance will also show you. So what gives you an evidence that you have paid for a service is what we call the receipt. Now here is what a receipt looks like. Get used to it. You can see sales receipt there. You see, you can see the name of the business issuing the receipt, the address of the business, the person to whom the receipt is being issued, what the receipt is issued for, that description of the product the receipt is issued for. You can see the stamp of the seller. You see, so get used to the contents of a receipt. You can grab a receipt anywhere you are, look at it and get familiar with them. These are the contents of what? Of a receipt. So if you ask what are the likely items you can get in a receipt, or you can find in a receipt, you should be able to tell them without, cramming. Now the next source document is what we call the check payment voucher, abbreviated as CPV. Now, when a business issues out the check, it usually fills a check payment voucher. So the check payment voucher shows the purpose for which the check is issued. You can get the amount, the person that the check is issued to, the date. You can see check number, and any other information required by the business. So basically, the check payment voucher is a documentary evidence that shows the purpose for which a check is issued. Now here is a typical check payment voucher. Now this is for MPS Technologies. You can see the payee is the person to which it was paid to. You know, the bank, the bank, you can see this keystone, that's the bank that the check is to be presented to, where the money is supposed to flow to the payee. And then we have the description for that, the purpose of the check. You know, we see it here, description, we see the amount, we see the check number here, the payment date. You see, we see the PV number here, we see the date, the check payment that was raised. So we see the total amount, and then we see the name of the person that prepared it, the date, the person that checked it, the date, the person that received it, the date, the person that approved it, the date. So these are the contents of what? A check payment what? Voucher. Get familiar to the content or with the content. The next type of source document here is what we call the cash payment voucher. We just talked about the check payment voucher, which gives you an evidence that shows the purpose for which the check is raised. But where you now pay in cash, you also feel what they call the cash payment voucher. So the documentary evidence that shows the purpose for which a cash or for which cash is paid is called cash payment voucher. Some business organizations use petty cash voucher. That is, they separate between main cash and petty cash. So when you separate between main cash and petty cash, you have cash payment voucher, you have petty cash voucher. They are the same thing, just that you're just trying to say one is for huge cash, the other is for what? Smaller or minor cash. So a document that shows what the cash is paid for is what we call the cash payment voucher or petty cash voucher. That's for minor cash expenses. So you should be able to see that it shows the amount involved, the purpose for which the cash is paid, the date the cash is paid. You see voucher number, the person to which the cash is paid, and all other information as required by the organization. Now this is how a cash payment voucher looks like. Almost the same thing with a check payment voucher, but the idea here is that this is for cash, the other one is for what? Check. So even you can decide to use cash payment voucher, petty cash payment voucher. That depends on the organization. If you want to separate between huge cash and small cash. So for the huge cash, you say cash payment voucher. For the smaller cash, you use petty cash voucher. So basically, a cash payment voucher or a petty cash voucher gives you an information for the cash paid. So you can see the date, the PV number, you know, the bank here, you can see office cash, the pay, the person that you're paying, the description, the amount paid, someone has to prepare, someone has to check, someone has to approve, someone has to receive it. So these are the information you expect to see in what? A cash payment voucher. The next one here is what we call a credit note. Now, a credit note is a note issued to an individual that has been overcharged by a particular organization. For instance, you sell to a customer, and that customer was supposed to pay you 100,000, but for some reason, the customer paid you 110,000. So there is an excess charge of 10,000 or an overcharge of 10,000. Now, the document the source document or the document you prepare to capture that excess charge before you enter into the customer's account is what we call the credit note. So it shows the purpose of the credit and then the amount with which you're crediting the what? Customer, which is usually the what? The overcharge amount. You know, another instance is, for instance, you sold to the customer, say 150,000, and then the customer now returns some to you, say 20,000 worth of product. That means that the customer had already, if the customer had already paid you, or the customer was supposed to be owing you 150,000 for the goods sold, and now the customer returned 20,000 worth of goods. You know, that will mean that what? The customer is now owing you 130,000. But if you had invoiced the customer 150,000, you have to raise a credit note to reduce the what? 150,000 to 130,000. So the idea is that when there's a situation where a customer has been overcharged, you raise a credit note, okay, to what? To reduce what the customer is owing by the amount with which the customer has been what? Overcharged. So the credit note can be issued to customers. That is where you sell to customers and then you overcharge them for whatever reason. You issue credit note, you know. But if you purchase and the supplier is overcharging you, in that case you are receiving what? Credit what? note. So credit note can be issued or received. It is issued to customers where we overcharge the customers, and then we receive it from where? From the suppliers, okay, where the supplier has what? Overcharged us. Now this is what a credit note looks like. You can see the name of the company is Repair Incorporated. That's the person issuing it. You can see the customer name here, John Smith. You see the address of the customer. You see, shipped to, that's the contact address of the customer. Then the items that cost the what? Overcharge. You see the description here, the quantity, the unit price, and then the total amount here. So the total amount of what? Credit here is 154.06. So this is what we use, to correct the overcharge, on the customer's account. Get used to the items or the contents in case you are asked what the contents are. Now we just explained credit notes, which is used to correct an overcharge, but it is possible to undercharge a customer. You see, so if for instance the customer is supposed to be billed 90,000 and then you bill the customer 85,000, you have to raise that 85,000 to 90,000. So the 5,000 additional charge is what we call the value on the debit note. So the debit note is a documentary evidence showing that an individual has been what? Undercharged for a particular product or service. You see? So for that undercharged value to be recognized, you prepare what? A debit note. And then you send it to who? To the customer to show that what? The customer has been under what? Charged. So for you to take that undercharged value into consideration or into account, you prepare a debit note. So this is what a debit note looks like. As you can see, balance due here. That means the customer is yet to pay 600,000. So you see the debit here submitted on, this is the date, bill to the company name. Then we have the description, we have the unit price, we have the total here. So this is typically what you see in a debit note. Remember, you are issuing to the customer to show that he has been undercharged. Now the next one is called what we call the journal voucher. Now in business accounting, it's possible that in accounting for transactions that you have already recorded, you can identify some errors and then you need to make adjustments. For you to make the adjustment, you raise what we call the journal vouchers. You see, so the journal voucher is the documentary evidence that shows the adjustment entries or the adjusting entries raised on a recorded transaction. The idea is that you have already recorded a transaction, but for some reason you identify that certain aspects of the record were not the way you wanted it to be. So you need to make an adjustment of entries. For you to make that adjustment, you raise journal entries. You raise journal vouchers. So the journal voucher shows the journal entries made, and an explanation for the reason for the adjustment. You see, for instance, there's an error identified after posting or recording a transaction. You need to raise a journal to correct it. So the documentary evidence that explains the adjustment is what we call the journal vouchers. Now here is a typical example of a journal voucher. This is for BJ Bison Ventures Limited. You can see the journal voucher. You see the address of the business, website of the business, and then you can see journal voucher number, the date the journal voucher is raised, description, the account code, debit, credit. You can as well see the amount in words. You see, someone prepared it, someone approved it, someone reviewed it, someone posted it. So these are typically what you expect to see as the content of a journal voucher. Remember, we talked about source documents being document from which information is obtained to prepare books of account. Now we're going to look at the source documents and the books they are connected to. The first one here, we have name of book, substitute name, purpose of the book, and the source document. Now we have sales day book. Another name for sales day book is sales journal. Sales journal is for what? For recording products sold on credit to customers. The connecting document, source document is what? Sales invoice. The next one is returns inward book. Okay, returns inward book, also called returns inward journal, sales returns journal, or sales returns book, is for recording what product returned. The source document is what? The credit note. The next one here is what? Purchase day book, also called purchase journal, for recording product purchased on credit from suppliers. Okay, so we have source document to be what? Purchases what? Invoice. The next one here is returns outward book. It's also called returns outward journal or purchase journal, a purchase return journal. It's for recording products returned out of what? Purchases. So you purchased from a supplier. Okay, you purchased from a supplier. Do you understand me? Say 100,000 worth of product. Now the supplier is what? Is going to say, okay, you're owing him 100,000. Now, if for instance, you return goods worth 10,000 to the supplier, that would mean that you are owing that supplier how much? 90,000 instead of what? 100,000. So what? You issue the what? The supplier a debit what? Note. Okay, that shows that what? You're going to debit that supplier with that amount of what? Money. But typically, understand that now, typically what is going to be done is what? To receive a credit note from the supplier. Okay, as against you issuing a debit what? Note. But the idea here is that when the credit note gets to you, it means that what? They are reducing what they are owing you. But you are also going to what? Reduce what you're owing them by debiting them. So technically, you are issuing them a debit what? Note. So we can say debit note issued or credit note what? Received. The next one is main cash. That's your cash book. You don't want to call it main cash, we call it main cash journal. It's for recording cash transactions. So what are the source documents? Your receipts, your cash payment voucher, and your check payment voucher. Okay, your receipt, that's for sales made and cash received. Cash payment voucher for cash payment made. Check payment voucher for what? Checks what? Payment what? Made. The next one is petty cash book. Petty cash book, also called minor expense book, for recording minor expenses. Source document is petty cash what? Voucher. And we have journal proper, which is also called main journal or general journal, for recording transactions that cannot be what? Recorded in the specific books. Okay, so what do you have here? We have journal proper. So here is a more detailed summary of what we just talked about. That's the name of the books, their substitute name, that's other names, the purpose of the book, and their connected source documents. You should be able to know this. So when you hear sales invoice, you should know the book that you're going to use to prepare it. Okay, I think the book, the information in the sales invoice will help you to prepare. When you hear credit note issued to customers, you should know the book of account that the credit note information will help you to prepare. When you hear purchases invoice, you should know the book that the information in the purchase invoice will help you to prepare. When you hear debit note issued to suppliers or credit note received from suppliers, you should know the book that this information in this note, this document will help you to what? Prepare. Now, having explained the source document for preparing books of account, there are other source documents, that you can get as much information as you want. Not necessarily for books of account, but depending on the organization, you can have other source documents, to get information for preparing some records. For instance, LPOs. LPOs are called local purchase orders. If you want to know the orders that you have made in a particular period, go through your LPOs. LPO does not guarantee invoicing, because it is possible for you to order for 10 items and at the end of the day 8 is supplied. The invoice will show the what? 8 items, not the 10 items. But if you want to know the orders made for a period, go through your what? Local purchase what? Orders. The next one is registered. So you can have registered varying from organization to organization. You know, similarly in all organizations, you can have what they call asset register. You know, asset register as fixed asset register or non-current asset register. It is for recording, you know, the list of fixed assets that the business has, their location, the amount, any depreciation, and the balance at a particular period of time. So information on, you know, fixed asset items you get from the fixed asset register. If you go to schools, there's something called attendance register. Even in organizations, you have attendance register. For instance, you want to monitor, you know, how workers are resuming and leaving the office. Some organizations will tell you that if you are late for 3 times, they take out payment for 1 day. So for you to get that information to compute this requirement, is you use the attendance register. So you can have as much registers as you want, depending on what you want to achieve. We have diaries. Some organizations use diaries. As individuals use diaries. There are some diaries that are basically for certain type of information. So you can get information. There are source documents as well. You know, for instance, in schools, we have diaries for course contents. That's the source of information. We have bills. You know, for instance, PHCN bills. You know, you want to know, you know, in detail. Maybe you want to authenticate the PHCN bills or power billing from PHCN for a particular period. Go through your PHCN bills. You have transfer receipt. This particular with banks. You know, when you make an online transfer, they give you an evidence of the transfer, which is called the transfer receipt. That's the source of information. We have files. You know, you can have as much files as you want for different purpose. That is also a source document. We have alerts. These days, every transaction you do, you get an alert that says, okay, this is the evidence of the transaction you just made. You see, so that's also a sort of document. We have bank statements. You know, a statement showing, you know, how you operate your account for a particular period. You know, we have vendor statements. It depends. So source documents vary from organization to organization. But the essence is that you need information for a couple of records. So you can have as much source documents as you want in the business that you're operating. You know, depending on the information that you want to achieve. So that is the class on accounting source documents, and then we also looked at other source documents. So you go through them and then also get yourself familiar with, you know, the type of source document that has been shown to you. On your own, you can do your field work, get hold of source documents, and then get to know the contents, you know, to help you, you know, with your exams, as well as, you know, keeping proper records for your business. If you have any question, you can reach me on 0813650636 or send me an email, jeremiah.dosu@gmail.com, or you can drop questions in the comment section over there to reply your questions with the right answers. Thank you.